Hi, today we're going to be looking at the difference between a credit score and a credit report. And we'll talk a little bit about what you can do to increase your credit score. And we'll have a brief discussion about why that may or may not be the best financial decision for you. So first, let's look at what is a credit score. A credit score is a number which predicts how likely you are to repay a loan or make a payment on time. It is a number that the banks generate to signal to each other whether or not you as a customer are worth the risk. Will you make the money? Will you pay them back? And the number is on a scale, and the higher the number you receive, the more likely you are to pay them back, and the less of a credit risk you are viewed as being. So the higher the score, the better your credit. There are three reporting companies that calculate what's known as a FICO score or a credit score for you. They're Equifax, TransUnion, and Experian. Each one of them has its own special formula for how they calculate your credit score, but they all basically come out to roughly the same number. When they're determining your credit score, there's really 5 things they're looking at. First and foremost, they're looking at your payment history. They want to know, are you the type of person who pays on time? All of the time, most of the time, some of the time, or none of the time. That's a huge, huge factor in determining what your credit risk is. They're also interested in how much you owe. They're looking at how much of your available credit you are currently using. So if you've been given a $5,000 credit limit and you're at $4,500 of used credit, that's going to lower your score because you're a bigger risk of not being able to make payments than if you were only using $100 out of that $5,000 that they have allowed you to charge. Another portion, a slightly smaller portion, is your length of credit history. They want to know, have you been making payments for a long time or for a short time? Those people who have a long history of making payments on time tend to be viewed as a lower risk because you've established yourself as having good character and it's been going on for a very long time, versus those who are new to credit, where the banks still not yet have developed enough of a comfort zone to know that you're going to pay them all of the time. And so those with a long credit history of paying off bills tend to have a better credit rating than those that don't. They also look at new credit. They want to know, are you asking for more credit now or not? Banks get nervous when you ask for more credit because that would indicate that you might be having a financial difficulty or a hardship, and that might increase the likelihood that you're going to fail to pay them. So they might extend new credit to you, and that's not a problem. But if you are asking for more credit, that generally lowers your score, at least a little bit. And then finally, they're looking at what types of credit you have. Is it all credit card debt? Is it credit cards and car loans? Is it student loans, home loans? They want to know what your mix of debt is to make sure that you're not racking up lots and lots and lots of credit card debt, for example, which would be an indication that you might be in a financially unstable situation, which would cause your credit score to drop. Like I said, your FICO score, the final score that is calculated, is based on a range. The lower the number, the more risky you are. The higher the number, the less risky you are. You may not actually want a perfect score of 850, and there are some very good reasons as to why that may not be what you're looking to accomplish. The most important thing to remember here is that the FICO score took into account your interactions with debt, but it didn't look at your income, for example. It has no bearing at all on how wealthy you are or what your resources are. It's just looking at whether or not you make payments and do you pay on time. And so it turns out that you can actually improve your score by having more debt. So if you are using 30 or 50% of available credit, you tend to have a higher score than if you're only using 5% of available credit. In part because if you are making payments and you are paying interest on those payments that you haven't fully made yet, that is, if you're carrying a balance, the banks view you as using credit responsibly because you've demonstrated to them that you can borrow large amounts, that you can pay it off over time, and oh, by the way, you're paying them interest. And so that certainly makes you a very good customer of theirs. And so they tend to raise your FICO score when you're carrying a balance relative to those who do not carry a balance. Overall, you want to make sure that you have a good FICO score, somewhere in the 700s. If you're going to be using a credit score, you should be in the 700s. But also keep in mind that the FICO score is there for those who want to use debt. So if you don't intend on using debt, you don't need a credit score. But if you're going to have a credit score, you better make sure it's good. What are some ways to build your credit? Well, one is to make sure that you have plenty of money in your savings account and checking account, and that you don't overdraw. That is, you don't write checks in amounts that are beyond what are in your checking account. Because if you have the resources to pay your bills and take care of your finances, your credit will be fine because you'll be making the payments that you're obligated to make, and that helps with your credit score. Having a steady job helps because steady jobs mean steady income. Steady income means that you can pay your bills frequently and on time without trouble. Any job is better than nothing, but bouncing from job to job creates instability and can increase the likelihood that you fail to make payments. Another way to help build credit is to put utilities in your own name. So instead of your parents helping you out by paying your electric bill or your gas bill when you go off to college and get your own apartment, put those bills in your name. Even if your parents are helping you pay the bill, having the bill in your name builds a credit history and helps you begin to raise your credit score. Same with cell phones and cable and internet. The more often your name appears on the bill, the better able you are to establish a history, which will help you build a solid credit score. The most important thing, of course, is to pay your bills on time every time. You may not pay the full amount. As long as you're making minimum payments or more and they're paid on time, that will help with your credit score. What happens if you had bad credit? Bad things happen. First and foremost, it makes it more difficult in today's economy to be able to rent an apartment. If you have bad credit, it means you're a risk to pay back. Apartments don't like people not paying their rent. So if you have bad credit, apartments are concerned you won't pay, and they may choose not to lease you an apartment. It's difficult to get loans like cars and mortgages if you're not making payments on time for credit cards because you're a risk. And if they do give you a loan, it's going to be at a much higher interest rate, which increases the costs of borrowing. If you want a security clearance, you're not going to get one with bad credit because you're a blackmail risk. The government looks at someone who has bad credit and says, well, they're susceptible to being bribed because they're worried about failing to make payments, and that's not someone that we want to give security information to. And it can make it difficult to get a job. Again, if you have bad credit, employers view you as being irresponsible. Irresponsible people do not get jobs. And also, it can increase the rate you pay on your insurance, like car insurance, because, again, if you are poor with your finances, you're generally considered to be reckless and irresponsible. And people who are reckless and irresponsible with cars tend to cause accidents, which raises the cost of insurance. So, again, if you're going to have credit, you better make sure that credit score is good. While your credit score is a number, it's important to remember that your credit report is slightly different. The credit report just lists all of the credit accounts that you have open, how much your balances are, and how much your limits are. And this is something you do need to make sure that you check pretty frequently because it's what will help you identify when people have stolen your identity and may have opened up fraudulent accounts. You can get your credit report for free every year through annualcreditreport.com. And you should do that in order to confirm that your accounts are correct and that the information that banks have on you is accurate. If it's not, you need to report errors immediately. Your credit score is something you typically have to pay for, so keep that difference in mind.